Hi, I'm Ken Shinoda, and I'm here to talk to you today about the advantages of structured products. In today's market, why should investors consider structured products? Well, there's the potential for higher income, and you can get that higher income with buying assets that historically have had a lower interest rate risk. And what we've seen is that after the global financial crisis, the structured products market has evolved. There's been quite some growth across the subsectors of the market, giving investors their opportunity to find diversification across a larger subsector of assets to get desired target exposures. And more importantly, I think there's been stricter underwriting standards for the underlying assets, the loans, the collateral. Rating agencies have gotten stricter on providing the AAA ratings. And of course, there's a lot more regulation like Dodd-Frank that has created things like risk retention, which means issuers now have to hold some skin in the game in these bonds. So the safety of the assets has gone up. So why now? Why should we look at these assets now? Well, years of Fed intervention and quantitative easing have taken interest rates to very low levels across many parts of traditional fixed income, and it's hard to find yield. And so going into the securitized markets is one place that investors can find that. We've also had aggressive and unprecedented monetary and fiscal stimulus that's created the potential for growth, inflation like we just saw today with a high CPI print. And of course, all these things can lead to rising interest rates. Why DoubleLine? Well, we've been doing this for quite some time. We launched DoubleLine here in 2010, but the team has been working together for much longer than that. So we've developed a time-tested process of credit management, credit underwriting, and asset management to be able to find and source these assets through the relationships that we've built throughout the years. How do we analyze these investments in securitized products? Well, first and foremost, we first look at who the sponsor of the deal is. Who is the deal? Who's bringing the deal to market? Who made these assets? Who's going to be the underlying equity potentially of this deal? Who has the skin in the game? And after we do analysis and diligence on that sponsor, we then look at the underlying assets. If it's a mortgage-backed security, let's look at the mortgage loans. What's the average credit score of the borrowers? What's the loan to value of the borrowers? What's the debt to income of the borrowers? What's the geographic distribution of the borrowers? After we look at those assets, then we'll look at also the broader market. What is our view on the real estate market? What's our view on the housing market? What are the fundamentals? What are the technicals? And we'll talk about some of that across the assets a little bit later. So once we've looked at the underlying loans, we've looked at the market, we then run our projected cash flows on those assets. How much will prepay on a monthly basis? How much will potentially default over time? What will the recoveries be if the underlying assets default? And we run those cash flows through the structure of those bonds. That's why they call it structured products, because these bonds typically have a kind of A note, B note, C note type structure. This is our stress testing. And through our stress testing, we can determine if we think these bonds are money good. And if they're money good, then we look at the pricing and see if it's attractive and appropriate, and we can buy these assets and we can input them across our different strategies. The work doesn't stop there. After we invest in assets, there's ongoing active management. We look every month, we get information about the performance of these underlying loans, if they're paying, if they're delinquent. We can then re-underwrite those bonds based on this new information, and that lets us to making kind of buy, sell, hold decisions on the underlying portfolio. So there's upfront underwriting and then ongoing asset management of these different securities and underlying assets. We can target different risk return profiles across the capital structure of these securities. On the left-hand side here, you see a typical capital structure for a securitization. At the very top, the AAA, followed by the other investment grade bonds, AA, single A, triple B, and at the bottom, the below investment grade bonds, double B, single B, and non-rated. The principal and interest payments have priority from the top down. We call that the waterfall. And then the losses come from the bottom up. So the higher you are in the capital structure, the lower the risk, the lower the return. And as you go down the capital structure, you can take more risk and get more return. And so we can target the different parts of these capital structures for the different strategies that we manage: low risk, intermediate risk, high risk, or even low duration, intermediate duration, and long duration. This is a snapshot of today's world. As you can see in the bottom left-hand side, you have the assets that are being bought and manipulated by the Fed with very low interest rates, the U.S. Treasury index being the lowest here at 0.9%. This is just kind of a basket of treasuries. And as you can see, within structured products, you can get more yield with each spectrum of risk. So in the high grade portion of the market, you have agency mortgages, which can pick up yield over treasuries. You have CLOs, which are floating rate, and pick up yield versus treasuries. This is the CLO AAA index. And even as I go down the capital structure and out the credit risk spectrum, I still have a yield advantage in many parts of the market. Here you can see BBB CMBS having the same yield as below investment grade high yield. BBB CLOs having more yield than below investment grade high yield. And so going into the securitized markets, I can often get more yield for the same rating and sometimes even for a higher rating than I would in the corporate market. We talked a little bit earlier about the duration advantage, having a lower duration. For securitized products, often there's more yield relative to duration than many of the other parts of the corporate market. One thing that investors can consider is the diversification benefits of securitized products. Here we see on the left-hand side the Barclays Aggregate Index, the Bloomberg Barclays Aggregate Index. You can see it almost has no securitized credit exposure, only 2%. And then what we did is we looked at the intermediate core plus bond category average. So we said, let's go look at all the core plus strategies out there and see how much securitized credit that they have. And the percentage on average has been 15%, which is on the low end. You can see mostly they go into corporate credit, about 42% in corporate credit. So adding securitized credit, if you own kind of your typical core plus type strategy, or if you're in a ag index fund, this can help you not only get that yield, maybe lower your duration a little bit, but also provide diversity from what most fund managers and most indices own. I talked about having a low duration, and obviously that would do well in rising rates. So what we've done is we've put together a couple of tables that show the performance of both low risk structured products and also structured products credit. So here is comparing US MBS, US agency mortgage-backed securities, relative to treasuries, relative to the ag, and relative to corporate bonds. And we picked periods of time where interest rates rose 100 basis points or so. And you can see that in those periods, mortgage-backed securities often outperform. It's not surprising. They typically do have a lower duration. They actually, almost in every instance, outperform both treasuries and the ag. There's a couple of years where corporate bonds did a little bit better, and they're usually after times of stress. When rates fall during times of stress, credit spreads are typically widening. So as the market recovers coming out of those periods of stress, those credit spreads tighten back in. And of course, corporate credit will do well in that environment. But mortgages do pretty well too. So here you can see in the 1988 time period, corporates up 493, mortgages still up 477. In 2010, coming out of the global financial crisis, corporates up 20, mortgages still up 7%. Of course, corporates were way down prior to that. So agency MBS does well in rising rates. This year is no exception, as we've seen them outperform the other parts of the high grade market. This shows periods of rising rates with credit information, and unfortunately these credit indices don't go back to the 80s. Sometimes they only go back to the early 2010s. And just the theme here to look at is the credit, the structured products credit, or structured products generally, is the blue colors. And you can see that the blue colors, if they're going to the right or they go less to the left, they're outperforming. So taper tantrum, they clearly did better in treasuries and the ag. In this bottom section, 2016 to 2017, summer of 16 through March of 17. Again, the blue is doing better than treasuries, the ag, and corporate bonds. moving to the period of rising rates through September of 17 and November of 18. Again, the blue thematically is doing better than the other stuff. And then last but not least, more recently, starting in August of 2020, when we saw longer term rates bottom in the US, the blue again doing better than the non-blue, doing much better, of course, than corporates and treasuries in this marketplace that we're in today. Even today, as I speak, interest rates are rising. What are the big macroeconomic themes that we see out there? I put this list together at the end of last year, and it still holds true. It's that we have a lot of easy money policy, aggressive fiscal policy. That's going to mean more deficits, more bond issuance, higher inflation, higher interest rates, reflation themes, and all this stuff is good for real assets as we see commodities rip higher every day, it seems. So all these themes I talked about at the end of last year are all coming true right now. Another theme that's continued to hold truth is the strength of the consumer and housing. The consumer had high savings going into the pandemic. They are benefiting from a lot of transfer payments, and thus, oddly, delinquencies are coming down. And we'll look at some of that data a little bit later. So the consumer is in a good spot. Consumer credit, like mortgage debt, credit card debt, auto loan debt, all are performing well. And that's important because they're a large part of the economy, consumer spending, and we need them to spend to continue to have positive economic growth in the US. And that's one of the reasons we're seeing that growth is because of the strength of the consumer. Last but not least, we've got the reopening of the economy with the recovery that's where we're amidst that right now. One of the setbacks we could see is the lack of success of global vaccinations in other parts of the globe, rise of new variants of the vaccine. You can see some of those markets have been underperforming. As we think about structured products, some of the big things we're looking at is the reutilization of commercial real estate, the return of travel, and on the corporate side, what we've really seen is a healing of corporate balance sheets and a repositioning of business models. So fundamentally, credit looks poised to do well here. It doesn't mean that spreads are attractive necessarily, but fundamentally, the credit of both consumers and corporates, the outlook is positive right now. 2020 was a year of gains across many parts of the market, especially those that had a lot of duration. On the left-hand side is the more investment grade stuff with duration. And then you can see in the middle here, bank loans, floating rate stuff lagging as rates fall. And of course, 2021 is the complete opposite of that. So 2021, we see that all the duration stuff doing poorly on the left-hand side and the risky floating rate stuff doing the best, like CCC bank loans, and some of the harder hit parts of the securitized market, like CMBS, given what was going on with COVID and the lockdowns, that's doing really well too. So what kind of didn't work last year is working this year, and we're seeing a reversal of those markets. The securitized markets last year, surprisingly, ended up having a decent year of origination. 2020, not as good as, of course, 17, 18, and 19, but on pace, I think, to kind of go back to normal. So there's going to be plenty of opportunities to find assets coming to market. 2020 saw record issuance in agencies with low rates. And that was, the Fed bought some, a lot of banks bought some too. And the supply definitely should be down a little bit, which is why spreads, I think, have come in a lot on agency mortgages. We're not going to go through a bunch of slides to talk about the underlying collateral within securitized products. These are kind of the big themes we're seeing out there. Here's the disposable income for individuals. It's gone up. It's gone up because of a lot of the transfer payments, and it's volatile. That's because transfer payments come, they fade, another transfer payment comes, and so you see this kind of volatility of incomes. But it's up a lot, which is really unique during times of recession. Usually, this shows delinquencies of consumer credit. Usually, you hit a recession, which are the gray bars. People lose jobs and they start defaulting on their debt. Almost every single time in the early 90s, delinquencies went up. In the early 2000s, delinquencies went up. And then in 08, they went up a lot because that was really an over-levered consumer getting hit hard. Savings rate of the consumer was very low going into that time period. The consumer was over-levered. Well, you can see even before COVID hit, the pandemic hit, the delinquency rates for consumer credit was actually below the long-term average. And we went even lower. Because of a lot of the help that they were getting from the stimulus. Here you can see on the left-hand side, credit card debt. People are paying down their credit cards. They're getting those checks. They're paying down credit cards. Credit card charge-offs are going down. Hopefully, they're spending some of it on American goods. Not all of it's going on American goods. Some of it's going into the stock market, as we've seen some of the crazy activity in the crypto, some of the cryptocurrency, and some of these meme stocks out there. Moving along to housing, the consumer is in a good spot. Some of them are wanting to buy homes, and the problem is that there's just not many homes available to sell. This is a chart I use a lot on the left-hand side. It's the existing inventory of homes for sale. It was already at very low levels going into the pandemic, and with the surge in demand for homes as people look to either move out of apartments, get more space because they're working from home, all these things in motion has moved the inventory of homes to an all-time low. And they were already at an all-time low before we started the pandemic. Look on top of this chart. You see the line going kind of to the upper right. That's the U.S. population, of course, which continues to grow. So less supply, more population, increased demand, and you have the recipe for home prices moving higher. Another thing that's helping to fuel home prices moving higher is that affordability, even with prices moving higher, is still high on a historical basis. The dark blue line is a housing affordability index. The light blue line is the mortgage rate. It's a little stale, should be moving up soon, but we only get this on a quarterly basis. And you can see that the affordability peaked in 2011 and 12. That's when home prices bottomed. That's also when we saw some very low mortgage rates. In July of 12, we saw the 10-year get down to that kind of 131-ish level, which was at that point the local low in rates. So when prices of homes were low and interest rates were low, affordability was high. Since then, prices have, of course, come up, and interest rates have come down. They did go up in 18. That's why you see the recent low in affordability was 2018. That's when the 10-year Treasury got to about 325. So there is room for affordability to drop if rates go higher. That's one of the things we're watching. Rates are moving higher, but even if they move higher, and let's say we go back to that affordability level of 2018 when the 10-year got to 325, and that's a long way away from where we are today. Even then, affordability was high relative to history. So I think that can help slow this crazy pace of double-digit appreciation that we're seeing in the housing market, but it doesn't mean that we're going to have a collapse in housing. Maybe we'll have housing go sideways. Maybe it'll go down a little bit. I think that'll be met with a lot of demand because there's a lot of people that are still trying to buy. On the left-hand side, you see that double-digit HPA or home price appreciation that we're seeing recently. And on the right-hand side, you see another positive fundamental for housing: high home equity. People have a lot of equity in their homes. People do not default if they have equity on their homes. I mean, they may default, but they don't walk away from their house and give it to the bank. What they do is they just put the house on the market, they sell it, they take their equity, and they go on with their lives. So a lot of that strategic defaulting, which led to more losses you saw on mortgages, I don't think it's going to happen again. So I think the losses on mortgages will be pretty low. And as you can see, these are delinquencies going up, and they're coming back down. Borrowers going into forbearance, which means they don't need to pay the mortgage for a certain period of time, and they're starting to come out of that forbearance as the economy heals, as people get more jobs, and you're seeing that in action. In fact, there's more jobs available right now than being filled, as we saw in the JOLTS numbers this week. I think that has to do with kind of what's going on with COVID and people getting paid too much to not to be unemployed. I think that changes through time, and eventually those numbers will get filled. Multifamily, also housing related, also doing strong. On the left-hand side, you can see different parts of commercial real estate, multifamily being the strongest. Multifamily is the line in gray. And you can see a divergence in multifamily prices across different geographies. People are leaving kind of San Francisco, New York, because of the pandemic maybe, and they're going to other parts of the US, some of them lower cost, some of them lower tax, not surprisingly, given what's going on with the tax situation out there. Taxes going higher, of course. Multifamily collection has been strong. I also think this is because of the help from fiscal stimulus. People have been getting using that money to pay their rent, to pay their credit card debt. Also see divergence in rents across multifamily places. San Francisco down the most, San Jose down the most. These are tech-heavy um, geographies, a lot of tech businesses there, and tech seems to be the most open to work from home. And people, so I think that's part of the reason that those parts of the market have gone hit the hardest. Let's talk more about commercial mortgage-backed securities. CMBS triple Bs in the green, recovering, still look perhaps cheap and some upside left. You can see they traded as high as 105 back in 2015. So you've seen a recovery in prices, especially after November of last year, with a combination of the vaccine rollout, more aggressive stimulus expected as the Democrats took over both the White House and Congress. Here you can see cap rates. Cap rates drive real estate prices. You can see it in the gray line, that's cap spreads. They widened into COVID. They got as wide as 500 over, but the light blue line, the treasury yields fell. So all-in cap rates, even with spreads widening, remained relatively low, which was supportive for real estate prices. So those lower rates, those lower risk-free rates helped support real estate prices. And then eventually, time passed, the economy's starting to heal. You're starting to see net operating income go up. You're starting to see delinquencies drop. You're starting to see vacancies decrease. So, and cap rates actually came down with cap spreads tightening. And so real estate prices started going up. On the left-hand side, you can see that the real estate prices are heading back higher. And a lot of it has to do with demand. There's a lot of investors that raised a lot of money to buy. Transaction volumes on the right-hand side, they're coming in to buy. They're coming in to buy the dip. As market participants like to say about stocks, the same holds true for real estate. The dip buyers are in, and there's a lot of money to buy the dip. There is, at the end of 18, there was almost 350 billion of equity capital, not including leverage, that was raised to buy real estate assets, and they're buying, they're coming in. So that's definitely been supportive as they see the light at the end of the tunnel. They've been active buyers across different parts of the real estate market. Even the hardest hit parts of the market, like hotels. Hotels were definitely one of the hardest hit parts of the market. You're seeing a big recovery. This has a spring break effect, March, April, spring break time. But you see hotels are finally recovering. So there's all kind of positive news coming across the different parts of these markets, especially the ones that were harder hit. Even malls, Simon Property Group came out and was talking about their earnings and saying that their rent collections are up. Foot traffic in malls, based on a Wall Street Journal article about a week and a half ago, suggested that 86% year-over-year increase in foot traffic. So people are back, but interestingly, they're spending money on casual wear that they're wearing at home, jewelry, accessories, watches, but they're not buying suits and formal dresses because there's not that many weddings going on, I guess. And people don't need too many suits. I haven't used this jacket in like 6 months. So transportation, also one of the harder hit parts of the market. Used car prices up crazy. A lot of press about this recently. We started talking about this a long time ago. There's just less supply and behavior of consumers are changing. They're not necessarily using trains and buses anymore, and so they need used cars, and we're having supply chain issues. So you see less used cars. But travel is even picking up. Here on the right-hand side, TSA checkpoint, passenger utilization coming through. So you're saying that we're not yet back to obviously pre-COVID, but things are definitely moving in the right direction. But it's not everywhere. U.S. domestic travel is up. This is searches on the internet for booking flights, and you can see that domestic U.S. Searches are up, but global searches are not up because of the problems in some of these other countries with COVID and just global travel down. So I think U.S. travel looks to be definitely picking up. I know LAX anecdotally is pretty busy, but global travel is still not the same as it used to be. Last but not least, I'm going to talk about corporate credit, CLOs specifically, which are the securitized products that own corporate bank loans underneath them. And you can see that triple Bs and double Bs have recovered, but they still have a little bit more room to run. So I think that we do think that the mezzanine portions of CLOs offer attractive risk-adjusted returns and relative value, which we have been adding to our different portfolios. And one of the reasons that we're constructive is that the worst from a default standpoint on the underlying bank loans is behind us. As I mentioned at the very beginning of the call, companies have gone out, they've borrowed money, they've improved their balance sheets, economic growth is improving. So the fundamentals look pretty good for now. There are some tailwinds. Not all these companies are in a great position. Some of these companies are zombie companies. They're only alive because of the debt. In the long run, they may not survive, but in the short run, everyone gets to kick the can down the road. And CLOs are actively managed. So if you find a good manager, they should be able to avoid those zombie companies and buy the better names. And we think they'll provide us with an attractive risk-adjusted return on a go-forward basis. To sum it up and then answer some questions, again, structured products, why look at it now? Well, in a world of low income, we can find more income in these assets. The income does help protect from rising rates, gives you some income to offset potentially lower prices. We also generally have lower interest rate risk historically in many of these securitized markets, as we've shown. And then lastly, a lot of investors, I think, are underweight if they're in a bond ETF that's just in the ag, or if they're in a core plus type fund that focuses on corporate credit, so can give you diversification. So I wish everyone a great summer, and now I'm going to go through a couple questions. Okay, what did the period of illiquidity in March 2020 teach you about the health of the structured products market, the strength of deal sponsors, market makers, etc.? So March was all about liquidity. The lesson is that liquidity is not the same now as it was pre-global financial crisis. Because of regulation, many of the banks are not in the position to make markets in high periods of volatility. Now, one of the things I talked about earlier, how since the global financial crisis, the structures of these deals are better, the collateral of these deals are better. Many of these securities, even though they went down because of technical supply-driven selling, have recovered fully because the expectations of losses is that many of these bonds will receive zero loss. So they've recovered in price. So I think that really holds true. The stronger underwriting guidelines, Fannie Freddie origination is stronger. Commercial mortgage-backed security loan origination is stronger. So I think that all helped these bonds recover. But surely the Wall Street is not providing the same liquidity that it used to. So I think when you see these bouts of volatility, the movements in prices will be sharper. And that's just something to consider for your portfolios. How might higher inflation impact prices of hard assets like residential real estate, commercial real estate, things like that? Well, of course, inflation is good for hard assets, right? Inflation raises home prices. It helps right now raise some commercial real estate prices up to a point. At some point, higher interest rates, which is the cost of debt for people that buying these hard assets, can start becoming a headwind. So I don't think that's going to happen yet, but that's something to think about. And like I said, we could go back to 325 on the 10-year Treasury, and that gets us back to affordability levels around 2018. So I think that'll definitely slow housing down, but not necessarily create a crash. Maybe it actually creates a buying opportunity for everyone that have been trying to buy, that have been priced out of the market. Which parts of the structured products market could potentially benefit from rising rates? Well, a lot of these assets are short, and even if they're fixed rate, they tend to do well in rising rates. So we've seen a big period of rising rates recently, and we have positive returns for fixed rate securitized bonds because of their short duration. They're still earning income. And we have many floating rate assets like CLOs, another reason we like them, that the coupons will go up if the Fed starts hiking rates. And they've done well in rising rates as well. So many parts of the securitized do well in rising rates. I guess the only way you really benefit from them is if you have a floating rate coupon and your floating index, whether it's LIBOR or SOFR, starts going up and your coupon starts going up. Do parts of the structured products market offer a complexity or illiquidity premium? I think so. I mean, I think that's why for the same rating, you often get more yield relative to your kind of corporate counterpart. It's just not as straightforward as, okay, here's Ford and their ability to repay debt, and we know they make cars, and here's their balance sheet, and they tell us about their balance sheet every quarter. It can be a more esoteric pool of assets, and not everyone has the expertise to analyze those assets, and there's not as many people that own them, and so I just think all those things lead to, on average, the ability to find some more opportunities in those markets within the securitized products. And of course, DoubleLine have been doing it for a very long time. How has the structured products landscape evolved post-global financial crisis? I talked about all that. Everything's underwriting stricter. The rating agencies are stricter. So I think the quality of the credit has gone up. Do you ever use equity-linked structured income notes issued by financial firms in your portfolios? No, those are different structured products. Those are not what we refer to as structured products. When we are saying structured products, they're debt deals backed by some kind of debt, unsecured, secured debt. Nothing related to those those kind of equity-linked notes that the investment banks put together for usually retail investors. So it's nothing like that. I think that was the last question. I thank everyone for your time. I hope this was informative. And again, have a great summer, and we hope to see you soon. Thank you.